Hello and welcome to the Tuesday edition of Market Briefing. I'm Martin Bakkerdax, European business editor here at the IB Times UK. Well, we're looking at strong gains across the region for European equity indices, benchmarks approaching 4.5-year highs. And it's not because of anything they've seen on the economic front. It really is more associated with the optimism that central banks around the world are going to continue to support asset prices with extraordinary measures. We, of course, have the ECB and the BOE meeting on Thursday. Yesterday, of course, we had some members, senior members indeed, of the U.S. Federal Reserve suggesting they're not going to pull away from stimulus anytime soon, and that's lifting stocks around the world. Now, the economic front today was actually rather grim. A composite reading of services and manufacturing activity in the Eurozone today read around 47.9. Now, 50 is a number that generally separates expansion from contraction. So this does suggest an even deeper recession for what has to be remembered is the biggest economic bloc in the world. Now, the difference or the separation between the pace of growth in Germany and the rest of Europe is indeed stark and arresting, and does suggest that actually that difference is going to need to be addressed not only by the Eurogroup finance ministers who meet today in Brussels, but also by European Union leaders who meet next week. Here in the United Kingdom, the news on the economic front was actually a little bit better, but really only modestly so. We have one of the best improvements in services sector activity for the month of February in around 5 months, and February retail sales actually accelerated at the fastest pace in about 3 years. Now, collectively, that very important component of the UK economy does suggest that we will probably avoid a triple-dip recession in the first quarter, but only just, probably by about 0.1%. That news won't come early enough, of course, for Chancellor George Osborne, who needs to make his budget statement on the 20th of March. But nonetheless, this may keep some of the wolves at bay with respect to those worries about triple dip. Sterling was a little bit more supported in foreign exchange markets this morning, and gilt yields bumped up a couple of basis points. Now, into the equity markets, probably the most important stock story of the day is Standard Chartered, UK-based bank, but really probably one of the most significant and most important emerging market lenders in the world. They delivered their 10th consecutive year of profits, an absolutely amazing story, and it came, of course, amongst a year in which they had the terrible embarrassment of having to pay around $700 million in fines after facing allegations of potentially trying to get round sanctions imposed by the United States for clients in various countries, including Iran. Now, the profit number from a pre-tax basis came in just shy of $7 billion. That was right in line with expectations. Only a 1% rise on the year, but what Standard Chartered did, I think interestingly, is lifted the dividend by about 11% over 2011 and also cut the bonus pool by about 7% to $1.4 billion. Collectively, investors really like what they saw, particularly some of the forward-looking statements from Peter Sands, the CEO, and they lifted the stock correspondingly. Last I checked, it was up around 3.5%. So do check that out and many other stories today on the IB Times Economy page. We'll see you tomorrow.